And we're standing by for the Reserve Bank's latest decision on interest rates. Joining me is business reporter Sue Lannin, senior business correspondent Peter Ryan and KPMG chief economist Sarah Hunter. Sue, let's begin with you. What are we expecting today?
Well, we are expecting a 0.5 percentage point rise by the Reserve Bank to 2.85%. So that's according to the majority of economists surveyed by Bloomberg. So if that happens, it would be the highest level of rates since April 2013 amid surging inflation. A small number of economists, though, are expecting a 0.25 percentage point rise. Now, we know there will be a rise because a few weeks ago we heard from the Reserve Bank Governor, Dr. Philip Lowe, and he said basically there would be a rise today because inflation is high, running at least about 7%, could reach 8% by the end of the year. We've got soaring food costs, petrol costs, cost of building new homes and also surging power bills. Now, 3 out of the 4 big banks are tipping a 0.5 percentage point rise tomorrow. Westpac is saying, Commonwealth Bank is backing 25 basis points. So let's have a look at what the markets are expecting. So looking at this graph here, very much a case of hawks versus the doves. So the consensus for economists is that rates could rise above 3% next year before dipping back. But the hawks in the market are seeing an official cash rate rise of more than 4% before rates dip back, Karina.
Peter, we'll bring you in outside the RBA. How much do you think the official cash rate will rise today?
Well, good afternoon, Karina. Look, here we are again for the 6th month in a row. We are expecting another rate rise this afternoon. It's not a question of whether they will pull the rates trigger, but it's by how much. As Sue Lannin mentioned there, the market's expecting another 0.5 percentage point increase, which would be the 5th supersized rate rise on the trot of 0.5 percentage point, but the 6th consecutive rate rise we've had since May, when rates started moving up from that unbelievable low of almost zero. So there'd be a lot of deliberation inside the RBA boardroom today here at Martin Place in Sydney, just about how far they think they can go. Have they seen enough evidence that inflation might be affected? Keeping in mind that those earlier rate rises are really only just hitting households and businesses now, and there's probably some way to go before those rate rises start making an impact. And I believe that the Reserve Bank will keep going hard with another 0.5 percentage point increase until they see evidence of the economy cooling or inflation coming down. But so far, it's not.
Sarah Hunter, we've probably got about 40 seconds before that decision comes down. What's been the impact so far of the rate rises?
Well, as Peter was mentioning, it's really early days. It feels like we've been talking about rate rises for a while now, but we've actually only been experiencing them since May. So it's really not very long in the context of an interest rate tightening cycle. And we're not really therefore seeing much of the impact feeding through yet. Those first rate rises are now starting to get into the mortgage rates for those people that have a variable interest rate that's attached to their mortgage. So we're starting to see perhaps some decisions from some households around how they spend their money. We're also seeing it, of course, feeding into the property market, and that's indeed where we typically see it come through first of all. So you quite often get the start of price corrections, and we're now seeing those across all of the capital cities, but also less new demand for residential construction activity. So house building becomes more expensive if you have to take on your mortgage to do that, and we're seeing that feed through into dwelling approvals as well. So the start of it getting...
I'm just going to break in now. Sorry, Sarah. We've just got the announcement, a cash rate target of 2.6%. So that means that rates are up 0.25 percentage point by 25 basis points to 2.6%.
So, Peter, that's very interesting. That's less than what most economists had been predicting.
Yeah, that's interesting. Has to be said, though, that the Reserve Bank Governor, Philip Lowe, was managing expectations in the lead up to this decision. He said there was going to be almost certainly a rate rise, but just how much? Well, we now know, 0.25 percentage point. So is this a sign that the Reserve Bank is now satisfied to sit back, wait for the evidence, to wait and see what the impact is, knowing that they've already gone in very, very hard on these rate rises and being aware of the pain being felt in the economy, particularly households with rising mortgage repayments. So that would have been a factor. So we'll take a look at the statement to read between the lines if we need to about why they've actually gone for that smaller rate increase in October.
Sarah Hunter, your reaction? Are you surprised by this?
Well, certainly the markets are going to be surprised by that. I think that the data probably could have warranted another 50 basis point rise. It's still pretty positive, and we know inflation is still very elevated. And I was just scanning the statement, and they made that point pretty clear that inflation is still very much well above target and will stay there for quite some time. I think it was interesting in the final paragraph where you tend to get the best bits on what might happen next. They are saying very definitely they expect to raise the rate again. So perhaps now we are seeing, yes, a slowdown in the size of the hikes, so to 25 from 50 basis points, but we've got more to come. So, projections of the cash rate above 3% still seem entirely consistent with where the board might be looking and expecting to take the rate going forward. But I think Peter's right. Perhaps they're now looking to assess the impact and really see it come through before they jump again. And worth keeping in mind, compared to other countries, the inflation rate here is lower. Our economy has been able to balance demand and supply better. There's not as much of a gap to close. So we shouldn't expect necessarily that the RBA will go as hard as other central banks have to and are doing so at the moment.
So, Sarah Hunter, is your assessment that this is, as Peter Ryan was saying, expectation management? And do you think that those quarter of a percentage point rises will continue for the rest of the year?
I think that's absolutely right and an absolutely reasonable expectation to have. I think that having slowed down to 25 basis points, it would be quite a step for them to go back to 50 basis point moves. So I'm not expecting that unless we see something very, very dramatic, if you like, in the data. But absolutely, the statement is definitely signalling more rate rises to come. And I think another 2 to see us through to the end of the year is a reasonable expectation, certainly my forecast from this point forward.
Sue, what are you seeing in the language in the statement from the RBA?
Yeah, well, the very key thing is the commentary on the global economy. And we have heard that in recent weeks from the Reserve Bank. They're saying one source of uncertainty is the outlook for the global economy, which obviously has worsened recently, and the impact on Australia. They also said it depends on how household spending in Australia responds to the tighter financial conditions. So obviously the cost of borrowing is going up. But I think that theme of the Reserve Bank being really worried about the outlook for the global economy, and that will make it harder for Australia to have a soft landing, particularly the situation in the US headed for a recession. England already in a recession, probably according to the Bank of England, and also the energy crisis in Europe and the war in Ukraine that's going on.
So, Peter, to come back to you, we have been hearing in the last couple of weeks Philip Lowe and what his legacy as RBA governor might be likely to be, and he doesn't want to be the governor that would preside over, say, a housing collapse in Australia. So are we seeing some of that influence today's decision?
Oh, well, certainly the Reserve Bank would be taking into account the impact on housing at the moment, although it's not a mandate of the Reserve Bank to calibrate housing prices, but they'd be very, very aware of housing values falling, particularly in the big markets, Sydney, Melbourne and Brisbane, although it has to be said that there were gangbuster price increases in 2021, around about 20% in some markets. So there is a long-awaited correction underway here. But as Sue was saying, it's the global economy that is the big variable here at the moment. We're safe here in Martin Place, knowing that the Reserve Bank will make the decisions for Australia's interests. But what happens around the world, the war in Ukraine, the impact of the COVID lockdowns in China, the near certainty of a recession in the United States, concerns about the stability of some investment banks around the world. There are a lot of variables at the moment that the Reserve Bank has to be prepared for. And also one of the other factors that they have to take into account is by moving rates up from zero, they need to have the ability in the future to prepare for the next crisis. Who knows when that's going to be, but they will need to have that ability to cut rates when they can. And there could be some rate cuts next year, maybe this time next year, once inflation starts coming down, but also to ensure that there's a soft landing from this. But clearly there's a lot of pain out there, and even though the Reserve Bank Governor Philip Lowe repeatedly says that there are buffers of something like $250 billion in early repayments made during the pandemic, there are a lot of households out there that bought in the last couple of years and don't have those buffers, and they're the ones that will be hurting from big rises in mortgage repayments over the last 6 months.
Sarah Hunter, do you agree with those sentiments in particular about rate cuts potentially coming next year? Are the banks going to have to now revise some of their forecasts?
Well, I think that, inevitably through any economic cycle, we go through periods where interest rates do go up, and we can see that historically. And typically, economy cycle, and that does then necessitate rate cuts to soften the sort of downturn on the other side. I think the timing of them is going to be interesting to navigate and challenging. I think it really will depend on response of the domestic economy to what we've already seen go in terms of rate rises, and that trajectory for inflation and domestic price pressures. If they really start to ease towards the end of next year and we see a really sharp slowdown in the pace of growth, then yes, rate cuts at the end of the year definitely possible. If that doesn't materialise though, then it could well be 2024 before we start to see the next cutting cycle beginning.
Okay, KPMG Chief Economist Sarah Hunter and our Senior Business Correspondent Peter Ryan, please stay with us on the line. Sue Lannin, I wanted to bring you in because we were basically expecting a 0.5 percentage point increase. It's 0.25 percentage point. So what does that mean for repayments for people with home loans?
Well, a lot of people would be breathing a sigh of relief. It hasn't gone up as much as people expected. So let's have a look at how much repayments will be if there's a 0.25 percentage point rise. These figures from Rate City. So for a $500,000 loan, an October increase means an extra $74. So that is an extra $700 that they're paying from May to October since the rate rises started. For a $750,000 loan, it means an extra $110 a month. And since May, that's an extra $1,000. For a $1 million loan, you're talking about $147 extra a month and about $1,300 extra from May to October. So they're quite sizable jumps in the size of repayments that people are making, along with the cost of living. So it really is putting some people at huge stress. They're already seeing people with jobs and mortgages going to food banks. I mean, there is a fear that some people will default on their loans or won't be able to get refinancing because they can't afford to make these bigger mortgage repayments.
Yeah, and particularly in the outer suburbs of Sydney and Melbourne. Sue, what's been the initial response on the markets?
Well, not surprisingly, we did see the Australian dollar fall. It was at about 65 US cents before this decision came out. Now it's buying around 64.7 US cents. So markets obviously expecting a 0.5 percentage point rise when there was a 1/4 percentage point rise, which suggests, as both Sarah and Peter have been saying, that the pace of rate rises is starting to slow now. And we've seen the market surge. It's up by about 3.4%. So again, investors actually hoping that the pace of rate rises by the Reserve Bank is starting to slow.
Sarah Hunter, if I can bring you back in, on Friday the RBA will release its half-yearly financial stability report. What will you be looking for in that?
I'll definitely be looking into what they're saying about the housing market and how households are dealing or potentially having to deal with these interest rate rises. I think that really is a key question at the moment for financial stability, obviously, given the size of the increases that have gone through. And I think the table that Sue just showed on the screen shows how much those mortgage prepayments might have moved for people, and how households are navigating through that. I'll also be paying quite a lot of attention in that space around what they show and tell us about the distribution of fixed mortgages and how those are rolling off and what the kind of refinancing structures for that look like. So how much are interest rates going up for that particular group? Worth keeping in mind that at the moment that group might not be seeing their interest payments go up, their mortgage payments move, but when they do refinance, they could potentially be moving by a lot. So the timing timing of that and the size of those moves, I think, are going to be crucial to how many households travel through the next 12 months.
Yeah, so Peter Ryan, if we can go back to the topic of house prices, the RBA in the lead up to today had been predicting about a 15% fall in house prices, but some economists had gone higher than that, with Barrenjoey forecasting 25%. Do you think there will be revisions to that now?
No, I think that from what major market economists have been saying, we should expect for more house price falls, getting up around 15%. There's still some way to go before that housing correction is over. Just looking at auction clearance rates at the weekend, borrowers who are new to the market can borrow less, have to borrow less because banks are charging more interest. Those checks and balances that the banks have, making sure that any money they give out at the moment, people are actually able to repay their mortgages, and that's actually been so important ever since the Banking Royal Commission, when banks were criticised for being a little bit too free or not having enough checks there. So, we've got a lot to roll out in the housing market, but it has to be said that this, on the other side of the coin, this is an opportunity for people who may be cashed up, ready to buy their first home, and some of those crazy prices that we've seen in Sydney and Melbourne are starting to come back to earth. But once again, repeating that we did have very big rises during the pandemic, and that was a correction that had to happen.
Sarah Hunter, how does the government respond in terms of fiscal policy in next month's budget?
I think the fiscal settings at the moment, it's definitely challenging. I think that it's really worth keeping in mind that the reason for the rate rises and in terms of domestic price pressures and where the domestic economy is that demand is still running hot relative to supply. And so what the RBA are trying to achieve, obviously, is a cooling of momentum in demand to bring it back into line with supply, and hopefully, as we've been talking about, achieve that soft landing. With that in mind, then, the RBA don't really want to see a significant fiscal stimulus coming through. They don't want a lot of extra spending. We've obviously already had the unwinding of the fuel excise cut, and that's helpful in that regard. And I think in terms of what I'm expecting to see from the government, they've been pretty clear that they're not going to be announcing a big spending package. They will be obviously talking about their what was in the election campaign and their commitments there, I expect, perhaps some additional policies that are related to the Jobs Summit as well. But I'm not expecting to see a big spending package come through. That wouldn't be consistent with what the RBA are trying to achieve, and it's also not what we've been hearing from the Treasurer and others in terms of where policy is going.
Sue Lannin, just run us through the decision again and how markets have responded.
Yeah, so we saw interest rates rise by 1/4 of a percentage point. Markets were expected half a percentage point, so the rate is now 2.6%. And the stock market really liked that because it means consumers have a little bit more money in their pocket because the cost of money is not going up as much as the economists thought. So the ASX 200 index currently up 3.6%, whereas the dollar's gone down, although it's recovering off those lows before. When the decision came out, it dropped to about 64.67 cents, but now trading at around 64.83 US cents.
Okay, our finance reporter Sue Lannin, senior business correspondent Peter Ryan, and KPMG senior economist Sarah Hunter. Thank you to all of you.